I think that's the biggest challenge with venture is that you have good, solid, strong companies that, given the right opportunities, without the pressures of boom or bust, could be great companies that add value, that make impact.
Venture Out Loud, where we have candid conversations on running a venture capital firm, as well as investing in founders, planning for profits around a purpose, and making a positive impact through entrepreneurship. Today, my name is Navin Goyal. I'm co-founder and CEO of Loud Capital. I have two incredible colleagues and partners of mine that they'll introduce themselves right now.
My name is Darshan Vyas. I'm co-founder of Loud Capital and Chief Growth Officer.
Hi, my name is Ryan Retcher. I'm COO at Loud Capital.
So today we are talking about how we started Loud Capital. Loud Capital is a venture capital and alternative investment firm here in Columbus, Ohio. We have offices in Chicago and Raleigh, and even an innovation center in Beijing. And the reason we are doing this podcast is because whenever venture capital, venture capitalists, fundraising, how to start a company, startups, all these buzzwords, all these keywords that we talk about and search for, there's not enough content, real stories behind how these things were done, how these things were built, how to get into the space. And we believe that the best way to educate and make the world a better place is to talk about how we got here, what we've learned, and what other people can learn. So we're going to talk about how we started Loud Capital. And there's no better person than my co-founder, Darshan Vyas over here, who, basically has been a big driver of the energy of Loud Capital since 2015. So D, why don't you tell us a little bit about how we started Loud?
Absolutely. So when I got into the entrepreneur space shortly after college, I had the opportunity to start a healthcare IT company. And fortunately for me, I didn't really go through the struggles that most entrepreneurs go through, whether it was serendipitous or, things happening at the right time, right place. But business was great. After my exit in 2015, I was trying to figure out what I wanted to do next. And I started investing in entrepreneurs and startups thinking, okay, this is a great idea. It's going to be a multi-billion-dollar company and I'm going to sail away and live life without problems. And then the reality hit that not all entrepreneurs have the resources or the experiences to successfully grow a business. So when Navin, my partner and co-founder, and we started talking, and I also had an opportunity to work with Ryan Retcher as well, we identified a problem that there are a lot of talented people here in Columbus and Midwest that come from a lot of great companies that are headquartered here. They're solving everyday problems, but they want to solve their own problems. They want to create businesses, but they don't necessarily have the tools and resources and the know-how to do so. So what we decided was we were going to come together, get resources together to supplement these entrepreneurs with capital, but with our own knowledge and expertise and our networks to help grow these companies. So that's where the name Loud Capital comes from. We're not silent investors, but we're active and loud.
And I want to reiterate, he said we wanted to bring our knowledge and expertise to the table. And I will transparently tell you that between myself and Darshan in 2015, we didn't have a ton of expertise. We had some knowledge. In fact, Darshan had way more knowledge than I did in the entrepreneurial space. However, what we did is we knew that we didn't have it and we knew we needed it. So we reached out to people, mentors, experienced professionals, and brought them in to help us solve problems. That is a big difference. We are not egomaniacs and say, hey, we know things, we're going to tell you how to do it, but we know it needs to be done. And so if we can't do it, we will bring people around the table. And that's kind of how we work. One thing I want to really ask is, Darshan, that's interesting that you said your first venture, sounds like you made a shitload of money, you were successful, didn't have many obstacles. So that is a dream. So are you telling me that this dream pathway caused friction on your second pathway?
Correct. So having, low expectations, right? So not experiencing any issues or problems, and then transitioning to a world where you're problem solving every day and helping entrepreneurs, it gets really frustrating and exhausting. It's challenging. My personal challenge is, how do you try to help everyone with the limited bandwidth and resources that you have?
Well, and one of the things that I saw in that time, as you guys were putting Loud together, was this unique situation where you guys were building Loud from day one, and you were investing in entrepreneurs and companies that were day one themselves. And so, just like any other company, you have your own challenges and issues as you're trying to build the company, and you're trying to also help all these entrepreneurs that are having similar challenges, different challenges. And so I know from experience and having that same challenge in my journey as well, that can be overwhelming. It's overwhelming to have to really feel and want to take on those issues like that they're your own, and you have your own issues that you're dealing with. So it's a really interesting position to be in, and seeing how it's evolved and how you guys and our team, as we've grown and we've built it, we've really learned from that. And we've learned from other people and their pain and their mistakes and what we've seen from people that we've been helping, and we've learned from our own.
And to reiterate, I think it's basically saying we were a startup investing in startups. And so we were trying to be as helpful and to bring as many people along to be helpful and help people build their companies, which we really believed in. At the same time, Darshan, myself, and Ryan came back and said, how the heck do we continue to build our company? How the heck do we bring investors into our vision so we can fulfill the vision of others? And by doing so, we can create huge impact for ourselves and for others. In retrospect, it's 2021 right now. We started in 2015. That was crazy. If you really think about it, would you do it again? I don't know if I would. I'm so happy right now. I'm probably most fulfilled I've ever been. I'm 44 years old. My second career, which we'll go into, my first one in a little bit. But it was crazy if you think about it. Let's raise capital, bring as many people as we can to be helpful, and invest the capital in other startups, which will need a ton of help, which would need other investors, other VCs, other institutions, other professionals, other consultants, other stakeholders to help them grow while we're trying to grow ourselves. Now that we're here, and I can put this really sexy social media post that yeah, start your own VC. This is amazing. I wouldn't do anything else, but it's crazy. And here we are. We've been through a lot. We believe in our vision. We're obviously talking about this. We're very passionate about education. We're passionate about people. But I just wanted to share that. It was crazy. One thing I will tell you, we're very conscious about talking about this and educating people on our journey. So if anyone out there wants to start a VC firm or wants to start with a fund, hopefully you have more knowledge and some mentorship than we had. And that's the goal.
And you brought up a great point, Navin. We were a startup helping startups. So that was a very challenging process because we were very lean. Essentially, we were working for free. We're trying to help startups. When I exited my company, my wife told me, I don't know what your future is or what your next steps are, but the money that we have, we're going to act like we don't have it. So we literally were working on fumes. And for a lot of people who want to start VCs, my only recommendation is have the proper backing, because the management fees that you get from the VC funds, they're very marginal. You need to have a decent sized fund in order to cover overhead. But we were able to bootstrap and work together and just keep our heads above water, and to see the evolution of when we started to how we've done it now. We've went through quite a journey, but it was a great journey.
And that brings up the point of the business model of VC. Let's talk about that. Ryan, you want to chime in on, I'm a small shop. I have a small fund. How am I making money? What am I looking for? How do I expect to put my full-time effort, energy, talk to my wife and convince her that this is the next step of our life? Tell me about that. Again, I do not hear enough people talk about the VC business model.
Yeah, my advice on that is don't. unless you're ready for a lot of challenges that aren't expected. We talked about a few of them before, but the actual financial model of venture funds, unless you're able to start, raise, and run a fund of significant size day one, you are putting money into a venture fund. The management fees, and typically most funds are structured in a way where venture fund managers get a 2% per year management fee of whatever the fund size is. And so if it's for simple numbers, if it's a $1 million fund, you make $20,000 in management fees every year. If it's a $2 million fund, it's $40,000 in management fees per year. Now, there are some expenses that are covered by the fund that aren't included by that, like some legal fees, marketing fees, fees to cover filing taxes, have a CPA and a bookkeeper take care of your books, all that type of stuff. But there's not a lot of money in especially smaller venture funds. So if you are getting into venture, or you think you want to get into venture because it's going to bring you a lot of personal money, then that's what I mean by don't do it. There's not money in venture. Your best case scenario, and the other side of upside and why venture managers get into venture capital, is for what's called the carry. And so as a general partner, as a manager of a fund, the most common standard for long-term upside is 20% of total profits of the fund. So if there is a total return on a $1 million fund of $1 million, meaning that you basically receive $2 million back on your original investment. So you're able to pay $1 million back to your investors, and then there's $1 million of profit. Then there is essentially $200,000 of profit that venture fund manager and the general partner is able to collect. So in venture, that's typically a long time horizon as well. So you might see that return after 5 to sometimes up to 10 years. So that's a long time horizon. You're having to invest yourself, your team, anyone that's involved in the day-to-day operation. You have to take on the liability, the risk of doing that and in placing investments on behalf of your investors. And then the returns are long-term. So you have to understand that coming in. And as Darshan mentioned, you should have some financial backing of your own to cover that, to be able to take that risk, go out, start a fund, so you get that experience and you're able to eventually do larger funds to make it lucrative.
That's a great explanation. So I'm driving in my car right now. I'm listening to this podcast and I hear significant fund. I hear, hey, don't start too small because there's not enough money in it. Give me an example specifically of a fund amount. I'm driving my car right now and I get 2 calls from really close friends who say, hey, we have investors. We want to start this fund. What should I say? Hell no, I'm not going to touch that because that's too small. Or say, this fund size is significant enough for me to be able to at least make some money. Like, what are we talking about here? I see $1 billion funds coming out internationally. I see $500 million funds from very large, well-known VCs. What are we talking about?
I think as an individual, you have to look at your network. You have to look at what you can bring to the table financially yourself to invest, what your friends and family, what colleagues, who is in your network that can invest. And that math can start to add up as to what you can do. I think if you're talking specific to the size of fund, you really have to dive into what you're trying to accomplish with that fund first, because it's not just about, again, the financial return always. I know when you guys, before you started Loud, you had your first fund. It was a $500,000 fund.
Yep. You heard it, everyone, a $500,000 fund. I now call it our first angel fund, which is what it was. It was otherwise known as 2 guys in a fund. and that was our first fund. We invested in 7 different companies, raised the money from people who knew us and thought we were credible and knew we were crazy enough to to really care about the money and to put it towards companies we cared about and wanted to put time in. But it was a very small fund at the time, and it was a side gig at the time.
So a $500,000 fund from basically your own funds and friends and family, and no management fees. So your intention wasn't to make money right now on this fund. In fact, I knew you guys then, and I'm almost certain your purpose for starting that fund was not to get rich. It was really at least twofold. One was to help the entrepreneurs that you believed in. You had those companies that you were investing in with that $500,000, and you specifically went out to your network to raise money because you believed in those entrepreneurs and you believed in their companies at that time.
Yeah, you're exactly right. And we did start this out because we saw problems that no one was solving. And those problems at the time were capital alongside many other things, but no one was taking care of the capital. And so Darshan and myself met these incredible inspirational entrepreneurs, people who you would be in conversation with and they said, oh yeah, I used to do this, but now my higher purpose is to do this. And I'm going to work my ass off for it, but I cannot raise any money. I have this amazing vision. I can communicate it. I have this deck that I've presented to multiple people and people won't bite. So after Darshan and I got to know a few of the entrepreneurs, and we really went over the opportunity of the vision of the company, as well as where we feel like being an investor, we really could make upside for our investors and ourselves. We committed to it. And so these were small checks. Obviously, a $500,000 fund, you're talking about $25,000, $50,000 checks. However, you're talking very early stage companies at the time in 2015 in the Midwest. And I want to, reemphasize what Darshan said earlier. In the Midwest, where you have a much younger venture capital ecosystem. For example, in the Midwest, you have like fourth generation venture capital. On the West Coast, you have 12th generation capital or 12th generation venture capital. What that means is you have a less sophisticated, less structured ecosystem of venture capital. So it's just less known. There's a lot more education to do. There's a lot less mature investors that are around who know the space very well. On the flip side, you have investors who want to invest in startups, and you have entrepreneurs who have trouble raising capital. That's everywhere around the world, but in the Midwest, it's pretty bad. And so if you can take a $25,000 check in a company that you truly believe in, you will take it and you will run with it and be as conservative as possible. And I know that's stereotypical, but in general, you have a lot of solid Midwestern folks who are trying to build something of value. And they're using your money and watching your money closer than many that we saw would. And so, this small angel fund, to what Ryan said, started a whole snowball of, I should say, activated the ecosystem in the area. And so you had entrepreneurs who were grateful for the investment. You had investors who initially invested in our angel fund who said, how can I invest in these kind of things? And so we became educators on what angel investing, what venture capital is, what startups were, why this ecosystem exists. And so that's been part of the fun. Darshan, do you have anything to add to that?
Yeah, going back to your original question, what size of funds should you be in? And it was clearly well stated that our goal was to really help entrepreneurs. And if you want to start a small fund, it should be done more of as a hobby, helping entrepreneurs and the impact that you're giving the entrepreneurs. To this day, we still get messages and emails and testimonials of how much it meant for us to support them in their time of need and early on and things like that. And regardless of how much other groups have invested, they've raised millions and millions of dollars, and we've had one company exit. They still remember us from day one. So I think for us, that is what keeps us going with Loud. I mean, our fund, even our current funds, the way that they're structured, it's not a moneymaker. I mean, let's be frank. It's we're not here to get rich right away. We're here to support the community, provide the impact, and hopefully it'll pay off in 7-10 years. and then we can keep rolling that over.
Yeah, and we're talking about the financial payoff. Let's talk about the community value payoff, right? So, disclaimer, we are capitalists. We plan on creating and building profit for ourselves. However, the way that venture capital and our funds are structured, like many funds, are when the investors win, we win. And so, how do we do that? And so, very early on, we knew that just looking at financial aspect, the financial data and the financial capabilities were not enough. We're not enough to make us feel good. There's other ways of making money. Darshan did it before. I did it in my old physician world. And so it's really much more than that. It's more comprehensive. So anyone want to expand on outside of financial impact for ourselves and our investors? What other things do you see the opportunity of venture capital?
Yeah, I think venture capital, I don't think I know venture capital has the power to make a massive impact on our society. There are a lot of entrepreneurs that can change their situations by building a great company that impacts people in their target customer base. It impacts people that they hire and give jobs to. So it creates that community value, and it changes the trajectory potentially of their families. So there's all sorts of different granular ways you can look at impact. And at Loud, we're very intentional about understanding the impact that the company is going to make and the why of the entrepreneur as to why they're building the company. And I think that's kind of the common thread of entrepreneurship and venture capital investing. You have to have your why straight when you're investing in a company. When you're looking at an entrepreneur and asking them, why should we invest in you? Why should we invest in this company? You want to understand and see that they are truly interested in adding value and building something great, because something great will make an impact. It'll make an impact on their customers. It'll make an impact on everything that we just mentioned, that I just mentioned a couple of minutes ago. And if they are able to build something great, then other things will come. And so when we look at venture capital, I think our mentality, I think all venture capitalists, frankly, mentality should be, if you invest in and you build something great, just to do something good and build something great, then great things are going to come, that we're going to profit. And Navin, you mentioned that we are capitalists. We want to profit. We don't believe that there has to be a compromise in that. There doesn't have to be a compromise in doing good right now, making the impact right now, and making money for our investors and making money for ourselves long term.
So you say that's where venture capitalists' heads should be. Where are some people around the world? Where is their head? Like, why isn't venture capital exactly the way you explained it? What is the opportunity to influence right now?
I think if you just look at the history of venture capital, it has largely come out of two central zones on the coasts. On one coast, it's tech-centric and building highly profitable tech companies, and then leveraging the returns on that to create new funds and continue to reinvest in these high-tech companies. And there's a long-standing model of success on that. And it is purely financial driven. It is looking at how companies can scale and add to their valuation and exit at extreme multiples of what the original investment is. I think that has been so successful that traditionally venture capitalists, that you can compare it to the investment banking model. It's all on paper. It's like, how do we maximize return? How do you maximize shareholder value for your investors that are coming in? If you help your shareholders win, if you help your investors win, then you are going to win as venture capitalists. So the focus has always been on that. And don't get me wrong, there's a lot of venture capitalists out there that once they make their money, they're going out and making huge philanthropic donations and donating to causes. So I don't want it to come across that I'm saying that venture capital is inherently bad. Traditional venture capital models are bad or inherently not impact focused. What we are saying, I think that what we believe is that you can have your cake and eat it too. You can focus on making an impact. You can look at more than the opportunity as, is this going to be 100x, return for us or not? And if it doesn't fit that 100x or bust, then that's where there's a missed opportunity for impact.
So let's clarify what you just said. There are venture capitalists who made a shitload of money, take that money, continue to raise more capital, continue to back technology companies that many of us use in our phone or use in some way. And a lot of that money or some of that money goes to philanthropy. So you haven't told me an opportunity. When you say you can have your cake and eat it too, what's the negative, there? People are making a lot of money. They're backing great technology companies that we use as consumers, and now philanthropy is occurring. Where is the opportunity?
I think venture capital is kind of like the pioneer of innovation. When you look at the old school way of getting financing are the traditional banks, and that's one of the reasons why banks are getting outdated right now. Venture capital started in the '60s, roughly, and back then you have your legacy businesses that have been around for 30, 40 years, and people retire, pass off the business to their kids. By the time they get financing, they don't need financing. I mean, that's the model with banking is, it's too late, to need that kind of financing. But venture capital, it's, quick growth, quick wins. Let me infuse money into this company. Let's grow it and let's sell it. And so for the investor, they get a really good, healthy return. But then what that does is, okay, now the entrepreneur can go off onto their next venture and think of something better, something more clever, something more innovative. And so I think that natural cycle of just constantly evolving and innovating is the benefits of venture.
That's great. And I agree with that. I think that's really well said. In general, venture capital is really an opportunity to fill in a gap of what banks originally were doing, no longer are. And I think there's an open space to do that in the way we invest. One of the other things I was asking Ryan was, you were talking about great successful venture capitalists making a lot of money back in technology companies that we as consumers use and potentially donating to organizations that we probably care about. But I think there are opportunities where there was a lot of money made, but there was also a lot of money put towards things that failed, which we're all entrepreneurs here. Failure occurs. We learn from it. We move forward. The question is failure being learned from? And what is occurring with those failures? Because we can all fail and we can learn from it and try to do better. Would you say the venture capital model traditionally is learning from failures or accepting it as a big portion of it and just pushing the gas pedal on success?
I think it's the latter in traditional venture capital, where there's a lot of forced failures. Let's say you're a venture capital fund and you invest in 10 companies. Again, the targets for those investments are 100 to 150x goal of return on those investments. So not all of those companies are going to hit the growth arc and reach that goal. Statistically, a little over one of those companies of the 10 will hit that goal of 100 to 150x. And traditionally, that drives the entire performance of that fund. And traditionally, the goal and average outcomes of a successful venture fund are about a 10x return on the original investor investment. So what you have is, out of 10 investments, on average, one company getting 100 to 150x exit that drives a return for the whole fund. Now, what happens to the other 9 companies that are in that fund? Well, they're invested in. Sometimes they're reinvested in. Some companies will get an initial investment and they spend the money. They they hire employees, they build their product or their solution, and they hit the market and no one cares. And so the fund is not going to reinvest. If they're not getting traction, then no one's going to reinvest in them. It was likely a failed premise, and that company is going to lose and shut down reasonably quickly, statistically. Then there is another kind of realm of companies within the 10 that they'll get some traction, they'll get growth, they'll get some additional capital, they'll earn that additional reinvestment from that fund or other funds. And at that point, again, they hire more people, they build more, they try to grow more. If they're not after that, oftentimes on that 100 to 150x growth arc, they're not shooting to the moon, yet they could be growing at a reasonable rate. That's more like a slow incline. Oftentimes, those are what are considered forced failures, in that they're not going to be that 150x return. The venture firms know it, so they're going to not invest any further, which by de facto oftentimes kills off those companies. And so I think that's the biggest challenge with venture, is that you have good, solid, strong companies that, given the right opportunities, without the pressures of boom or bust, could be great companies that add value, that make impact, that hire people, employ people, that contribute to society, but they don't oftentimes have that opportunity.
And that usually requires an entrepreneurial mindset, which many venture capital firms probably need more of. And I will say that, to wrap this up, basically venture capital currently focuses a lot on the financial aspect of it. And so what we try to do comprehensively is the people aspect, the problem solving aspect, and the financial aspect. So you have your winner that's going to make a ton of money for investors and for ourselves. However, there's these other great companies that you have already put money into that are creating jobs, solving problems, helping stakeholders out there. And that is of value as well. And so some will not make it, some will fail, but complete support until it fails and to see if we can do anything else is what we're talking about. That's the opportunity of venture capital. So I thought this was a great discussion. I just want to wrap this up. This was our first episode of Venture Out Loud. I want to really thank my partners, Ryan Retcher and Darshan Vyas, for joining me today. And I really want to just say that the goal of this podcast, once again, is to really open up the discussion on investors, entrepreneurs, stakeholders. Venture capital touches all of that, and we're here to help shape the industry. Thank you very much for joining us.